everyone. Happy Thursday. Welcome to our year-end and third quarter edition of the Equifax Business Credit Trends. I'm Sinead Gleason, product lead within the commercial line of business. I hope you've all had a very productive 2025 and are heading into the holidays with a sense of accomplishment and looking forward to some downtime. I know I am. Today, we're going to look back at the results from the third quarter. And as always, Jeff Brown will join us for a deep dive into the Business Health Index. And also joining us today is our crack team of knowledge droppers, our commercial consulting team. They will share their insights from their individual areas of expertise to round out the data that we see in the slides. We have Anna, Josh, and Kevin presenting with me today. These folks joined us last year for the Q3 webinar, and it was a great session. So I'm thrilled to have them back again to drop some 2025 knowledge on all of us. But before I get too far ahead of the agenda, let's pause here for some housekeeping items. Jordan, over to you.
Thank you, Sinead, and good afternoon, everyone. Welcome to the final Business Trends event of 2025. Thank you so much for being here with us today and for joining us throughout the year. We are grateful for your continued support. If this is your first event with us, welcome. I'm here to provide you with a brief overview of the platform you see in front of you. For some of you, this will feel like Groundhog Day because we had an event yesterday. So if you've heard me do this before, just throw up some thumbs up emojis. Each area within the On24 webinar platform is responsive so that you can maximize or minimize each widget or box on your screen based on your viewing needs. There is an Ask a Question widget underneath the media player, so feel free to enter any questions you may have and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we'll reach out to you individually to follow up in the coming weeks. Today's presentation in English and French is available for download in the related content area, along with a lot more great material. The session is being recorded and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are reactions so that you can let us know how we're doing, what you like, what surprises you, what you love, our contact us, and our survey. You can fill all of that out during or after the session. Feel free to check any of these out and provide your feedback. Even if you've done it before, we really appreciate fresh comments. And with that, let's get it started. Sinead, back over to you.
Thank you, Jordan. Okay, so starting things off today, we'll review some macroeconomic data from the third quarter. Firstly, reviewing the GDP. Big news of the quarter was that we avoided a technical recession, but the rise in GDP was because of a shift in the balance between imports and exports. As we look a little bit more closely in a couple of slides, imports experienced an 8.6% decline, while exports rose by 0.7%, primarily from rises in crude oil and bitumen shipments. There was government spending on key areas like military investments and residential investments, which helped as well. But during this quarter, household consumption fell by 0.1% overall and by 0.2% on a per capita level, with a key driver being reduced spending on passenger vehicles. Okay, next we'll look at the inflation numbers. The chart on your left shows the percent change over time starting from January 2019 to October 2025. And for CPI, or Consumer Price Index, that's represented by the gray line there. It was up by 2.2% in October compared to the same period the previous year. This was a slower pace of growth compared to September, which saw a 2.4 year-over-year rate of growth. Consumers paid more for groceries, home and auto insurance, but they did see some relief at the pumps. Businesses saw continued price increases on raw and industrial materials, with both the IPPI and the RMPI growing approximately 1.5% month over month from September to October, or nearly 6% each compared to the same period last year. The primary driver of that was price gains for non-ferrous metal products and higher prices for metal ores, concentrates, and scrap. The third quarter saw another widening between imports and exports, although not as pronounced as what we had seen in the second quarter, but it still trends as a widening deficit. In August, exports fell by 3%, while imports were up by 0.9%. Canada's merchandise trade deficit with the world widened from 3.8 billion in July to 6.3 billion by August. This reduction in exports will likely cause Canadian businesses to re-examine their supply chain strategies. And the industries that were most impacted by the contractions were, probably no surprise, but metal and non-metallic mineral products. Those were down by 7.6%. Industrial machinery, equipment, and parts down by 9.5%. Forestry products and building and packaging materials down by 10.1%. And while we're talking about the third quarter results in these slides, the impact of these numbers really hits home given recent announcements this past month about various plant closures across the country. Okay, it's been a challenging environment, that's for sure. So when we look at the labor market, sectors with the most gains in employment were wholesale and retail trade, transportation and warehousing, information, culture, recreation, and utilities. And on the flip side, construction saw the most declines. Overall, there were 67,000 new jobs added in October, 60,000 in September, and combined, those two monthly gains made up for losses that we'd seen in the first part of the quarter. Okay, August and September saw the unemployment rate reach the highest non-pandemic levels that we'd seen since 2016. They reached 7.1%, but as we just saw, by October, things started to improve. Regionally, Ontario led the way in jobs growth in October, where 55,000 jobs were created. That represents 82% of the 67,000 total net new jobs nationally. The only other province with a notable increase was Newfoundland and Labrador, which added 44,400 jobs. And in terms of demographics, the youth unemployment rate saw a nice trend reversal in October, declining 0.6% compared to September. However, the 14.1% unemployment rate for that cohort is still elevated compared to the same period last year, and that's really helping to push that overall number up to 6.9%. So while the third quarter started off a little bit weak, by October, the labor market started to see signs of improvement. And then in terms of the number of active businesses in Canada during the third quarter, things look pretty steady. There were some business closures in professional, scientific, and technical services, retail trade, and accommodation and food service, but those were offset by gains within healthcare and social assistance and construction. Another indicator of the health of the economy is retail sales. And we can see that consumers are spending less on discretionary items. They're prioritizing essentials such as food and gas. Sporting goods and miscellaneous, they also reported growth as well, which could potentially be attributed to the back to school period because books and art supplies and those sorts of things are captured within that miscellaneous category. But overall, credit card spending was down this past quarter by 1.6%. Okay, now that we've seen how the data played out last quarter at a macro level, let's now see how businesses were feeling about how the quarter and year ahead of them was feeling. And so for that, I'm going to pass things over to Jeff to walk us through this quarter's Business Health Index numbers. Welcome, Jeff.
Perfect. Thanks, Sinead. So as a reminder, the Canadian Small Business Health Index combines survey data collected by the Business Development Bank of Canada, credit information from Equifax, as well as macroeconomic data from Stats Canada and Bank of Canada. So as of November, we've also introduced new industry indexes, which cover construction, manufacturing, retail, and wholesale trade. So trade tensions between Canada and its major trading partners have taken their toll on Canadian small businesses. While exports have slowed due to tariffs, they've stabilized, albeit at a lower level than the beginning of the year. However, the impacts of tariffs are not felt equally across really each region across Canada. Manufacturing, particularly in metal industries, as Sinead mentioned, concentrated in Ontario and Quebec, was directly affected by tariffs. Sectors exposed to U.S. trade have experienced employment losses, but gains in other sectors have really offset those. Overall, consumer spending remains a key driver to growth in Canada. So demand conditions are slowing as uncertainty settles really into the outlook into 2026. Small businesses have also been oscillating between pessimism and optimism since the start of the year. The situation appeared brighter at the beginning of September as trade talks with the US seemed to progress, and the federal government announced spending on major projects. However, things quickly turned kind of negative at the end of the quarter as US has really been talking about a new wave of tariffs on Canadian products. The seesawing kind of makes it back and forth, makes it difficult for small businesses and ecosystem players to assess risks and navigate the current context. While small businesses are really showing resiliency and they're supporting kind of positive outlook moving forward. The national index has climbed to 99.6 in Q3 of 2025, a 2.8% increase from the previous quarter. While uncertainty remained elevated, consumer fundamentals were solid. Employment held up despite weakness in the manufacturing sector. The Canadian economy also showed resilience to tariffs, which helped restore some confidence among entrepreneurs. This momentum may be short-lived, however, as trade tensions have reignited and really casting doubt in some of the recovery that we're all looking forward to. The quarterly rebound was driven by a 9.7% surge in sentiment and a 2.9% rise in growth projections, reflecting increased optimism. General economic conditions improved as the effect of last year's interest rate cuts became evident across the country. The current context really affects some sectors more than others. The manufacturing sector, which US tariffs have almost directly impacted, has really struggled this year. In Q3 of 2025, the manufacturing index posted a 2.1% annual decline and a 1.5% quarterly decline. Meanwhile, the construction and retail and wholesale trade sectors all posted gains in the index. The construction index rose by 2.6% quarterly and 4.6% annually. Stronger sentiment and growth projections among construction small businesses compensated for a weaker employment in that sector compared to the second quarter of the year. The retail and wholesale sector benefited from a resilient consumer as spending and retail sales continued to grow. In recent quarters, small businesses in the sector have demonstrated greater confidence in higher employment, as Sinead outlined, resulting in an index of 6.2 higher than and 6.2% higher increase than the previous quarter. So it'll be interesting to see what small businesses think of the recent fall budget that was announced. So there was a lot of funding that's going to be happening across Canada as we build Canada and buy within Canada. But we'll really have to see following the holiday season really what the small business sentiment is going to look like. And with that, I'll pass it back to Sinead.
Awesome. Thank you, Jeff. It's good to hear that businesses were feeling optimistic heading into the last half of the year. So let's now take a look at this quarter's credit data. And what we'll see will reflect a little bit of that optimism that Jeff spoke about. New credit activity rebounded with easing inflation, particularly in industrial trade or originations. Financial delinquency rates remained high across industries and key regions like Ontario, but supplier repayments remained strong as delinquency rates on invoices report a significant drop. So let's take a closer look. Okay, first up, the average debt per business. It grew again in the third quarter by 19.6% year over year to just under $31,000, driven largely by an 83% increase in balances for newly established businesses. Balances on cards have continued to decline, and the growth came from installment loans and mortgages. Installment loan balances have grown by nearly 18% to sit at just over $14 billion. Demand for credit was up this quarter in almost every region with the exception of Nunavut and the Northwest Territories. Notably, many eastern provinces saw double-digit growth in demand. A lot of this increase will have come from soaring costs in raw materials as businesses are adapting to a rapidly changing environment. The only two industries which saw a decline in credit demand was transportation and warehousing, as well as accommodation and food service. Okay, on this slide, we're looking at new account openings. In the graph on your left, The gray line represents new accounts opened within financial institutions, and the yellow line is new trade supplier accounts. On the right-hand side is the product mix for financial trades. After last quarter's sharp decline in new account openings, we see a soft rebound this quarter. Supplier accounts reported a more pronounced gain. Overall, originations were up 13% compared to the second quarter. And when we look at financial trades specifically, the majority of the growth came from installment loans. I'll pause here and invite my colleague Kevin Freeland to share some insights with us all about what we're seeing here. Kevin is a consultant at Equifax focused on our small medium enterprise segment. Hi, Kevin, come on in. What are your thoughts on what we're seeing here, and what are you hearing in the industry?
Thanks, Sinead. So as Sinead pointed out, we're seeing an uptick in new originations, which is new accounts being opened with both the banks and industrial trades. I'm going to touch on a few reasons for this. One is supplier diversification, and that's just a fancy way of saying that as suppliers get stricter in governing their credit limits, companies are forced to expand their supplier network, and we're seeing a lot of this. Retooling. So we've spoken to several companies impacted by tariffs that shared with us that they're creating new lines of business as a pivot strategy. So a recent example came across, it came into my world. One of our customers was explaining that they traditionally produce raw material, and they started a digital division to create digital building designs, which complements the type of materials they supply to the construction industry. What was fascinating was that this was totally outside the realm of their traditional business, but they saw it as a necessary evolutionary pivot necessity. And as companies retool and create new divisions and product lines, they seek new suppliers to do so. Another factor coming into play is and I practice this acronym, the CSBFP program, this Canadian Small Business Financing Program. Here I now refer to it as the program. This is a Canadian government initiative. It's been around for a while, but it helps small businesses or companies with gross revenues under 10 million, with access of loans up to, it's been increased to 1.15 million. It's a pretty lucrative program in that startups receive up to 70% in financing. So anyone with sons or daughters, you might want to suggest they consider a program like this. That's pretty lucrative. The program now includes lines of credit, working capital, and a new and a very liberal, I might add, financing classification called intangible assets. And examples would be franchise fees, goodwill, incorporation costs. And under the right circumstances, this could be a program for some suppliers to suggest to their clients to explore further. Now, these loans are administered by the banks, and 85% is guaranteed by the government. So this program has been in place for several years, as I mentioned, but we're witnessing a significant spike, some of which we attribute to Mr. Carney's 60 billion fast track projects, as companies will be created and are being created in anticipation of these projects. So for example, the current fiscal year, which runs their fiscal year, is April 1st to March 31st. The program reached a program high of 6,409 loans, totaling 1.9 billion. And this is higher than even pre-COVID. And as a point of reference, the full fiscal year, 23 to 24, their loans total 1.7 billion, which means they're tracking 7% higher year over year, and we still have 2.5 months to go. The increases we see in these loans correlate to more activity, which contributes to the uptick in new originations. And on the right-hand side, we see a significant increase in installment loans. Back to you, Sinead.
Thank you for that, Kevin. That is so insightful. Love when you guys bring all this information. It really rounds out the information that we see on these slides. Next, we will look at asset-based lending. And for this, I'm going to hand things over to another one of our subject matter experts, Anna Baunis. Anna has a wealth of expertise in the asset-based lending segment. She works closely with many lenders. Anna, over to you.
Thank you so much, Sinead. Hi, everyone. I'm a credit strategy consultant here at Equifax, and I support lenders such as auto and equipment, captive finance companies, leasing companies, and really any company who provides financing to small businesses and has security by some sort of asset. And today, I wanted to speak to you a little bit about the trends that we're seeing coming out of our asset-based lending database. So here, what you're seeing on the left-hand side of the screen, we're looking at a change in inquiries year over year. And we use this as a proxy for tracking credit demand. And what we saw in the first quarter of 2025, it was a bit soft in comparison to that same time in 2024. But then by Q2, the demand was up, both on a quarter over quarter and on a year over year basis. We saw it peak back in May. Now looking at Q3 demand, it was recorded as a quarter higher than Q1. But when we start looking at the monthly view, we do see September of this year as being the softest month of the year so far, at about 3.5% less than the demand that we saw back in January, which was the second lowest month of the year for inquiries to our asset-based lending database. Now, on the right-hand side, we're looking at how these inquiries translated into funding. So net new loans, net new leases, the dollar amounts that are out there in the industries. And we refer to these as trade lines reported to Equifax. So this view is really a year-over-year view. It's capturing specifically September, what it looked like over the last 3 years. So we're looking first at December 2023, how it compared to 2022, then September 2024, how it compared to the 3, and then lastly, how September 2025 is faring over September 2024. And I like this view because it really strips away any kind of seasonality factor, and it really hones in on the underlying trend. What did it look like when you really compare it to a year-over-year view? And so we're seeing less dollars opening in the construction space, the retail space, and in the transportation space compared to the same month last year. And we're seeing more dollars for agriculture, manufacturing, and professional services than in September of 2024. And really, when we dig into this, it ties back into what Sinead mentioned earlier. So, for example, starting with retail, the decline is a direct effect in the shift of that consumer behavior. So we observed that in Q3, retail sales were dropping. Consumers are prioritizing essentials over discretionary spending. We also saw that retail had one of those largest decreases in active businesses. And soon we'll even showcase that it has a higher than average delinquency rate. So all of this is tying back into the conservative approach that's happening on capital expenditure for retail. And when it comes to something like construction, many businesses we hear are still feeling uncertain about the financing and interest rate environment. We've all gone through those 10 subsequent interest rate increases from 2022 to 2023, and then the subsequent rate cuts. So construction projects, typically very large dollar value investments, I hear that they're being somewhat delayed because of this kind of capital investment requirement until the financial landscape is a little bit clearer. And then, as Jeff mentioned, there's still the unpredictability around the price of essential materials. So steel, copper, aluminum, lumber. It makes it extremely difficult for firms to accurately estimate and budget for these projects. They're questioning whether the cost of materials is going to surge between the time that they accept a bid and then when the materials are purchased. So the economic and trade policies, like the imposition and then the removal and then the reimposition of tariffs and any kind of sudden variable costs is definitely a factor in all these geopolitical events. We do see them translating into our data. In contrast, it's all over the news. We hear a lot of buzz around return to office mandates. So that actually might explain some of the rebound we're seeing here in professional services. These investments are typically seen on specialized equipment, like office equipment, technology, and some businesses are expanding their office spaces now. Some are modernizing. So hopefully that provides a little bit of additional color to the credit demand side and the credit origination trends. And I'll pass it back to you, Sinead.
Awesome. Thank you, Anna. Next, let's look at arrears and debt. Fun stuff. On the left is the number of businesses that have at least one missed payment. And so the good news here is that missed payments declined by 2.1% compared to last year. Last quarter, we've been seeing that number rise, so this comes as some positive news. On the right, we're looking at average balance per business indexed back to Q4 of 2021 by financial trade product. So cards are in blue, installment loans is the red line, and lines of credit are in yellow. And there we see the average balance on cards coming down this quarter, but compared to the same period as last year, the average balance grew by 7.1%. Lines of credit, while up this quarter, declined by 4.1% versus last year. And then lastly, installment loans, while they've started to even out, the average balance on this product is up by a significant 27.2% compared to the same period last year. And Kevin, I think you have some insights that you want to share about what we're seeing here. So I'll welcome you back to share your thoughts.
Thank you. So here, as Sinead pointed out, we see the number of businesses with at least one missed payment has dipped. That's great news. A small part of this correlates to the CSBFP, good thing I practiced, money circulating, but a bigger impact, I believe, is supplier prudence. And I'm going to dig into this a little bit deeper in some upcoming slides very shortly. On the right-hand side, once again, we can see the impacts of the record CSBFP loans impacting the 27% year-over-year increase in installment loans. But we also see credit card balances increasing. And this trend is related to small businesses, mid-sized businesses using credit cards as payment options being forced upon them by their suppliers for more prompt payments, and also personal facilities. I'm going to touch on this shortly as well. Back to you, Sinead.
Awesome. Thank you, Kevin. So recapping the business growth data, Canadian businesses illustrated a renewed sense of optimism in the third quarter, an improved economic environment with easing inflation and interest rate reductions fostered a resurgence in business confidence and investment growth. There was an increased demand for business credit, and this increase in demand directly correlated with intense cost pressures for goods and materials. And then regionally, demand for credit was on the rise nationally. Certain provinces felt the changing trade dynamics more intensely, with Ontario seeing a particular concentration of economic strain. Okay, now we'll look at the different trends between the supplier side and the banking side. So first, we're going to look at the supplier trades, and these we refer to as industrial trades. And on the left side of your slide here, those are the delinquency rate trends by quarter, and on the right, we're breaking down the later stage delinquencies by province. So looking at this quarter's results, we see a pronounced drop in delinquency rates down to 10.3% on the supplier side. And this was true nationally, as we see a decline in delinquency rates in each province. So I'll ask Anna and Kevin to come back and talk to us a bit more about what we're seeing here. Anna, let's start with you.
Sure thing, Sinead. Thanks so much. I thought it might be best to just maybe take a quick moment to elaborate on the industrial trades a little bit, specifically how they differentiate between the asset-based trades that I was speaking about a little bit earlier and the financial trades that Josh will be speaking to shortly. So Equifax has many different lenders and suppliers that report into the database. And we've also grown by acquisition of database as well. So here on this slide in particular, we're looking at all the lenders and the suppliers that report into the original, I call it the OG Equifax commercial risk database. And the easy way to think of industrial trades is essentially as non-financial trades. So anything that does not come from a financial institution and does not come from a bank or a credit union. And these industrial trades can be again, a mix. It's a supplier trade credit, so an invoice for a good or a service that was rendered, which has payment that's due within a certain amount of days. But they can also be loans and leases from captive finance companies, like when you go out and buy a vehicle and you get financing from the brand, the manufacturer's direct financing arm. So what we're looking at here is really a mix of both of those non-financials, non-bank trades, so the suppliers and the loans and the leases. When I meet with my customers, obviously, I'll drill down deeper, right? We'll go into the specific industry, the specific type of credit that they extend in order to give more tailored insights. That's one of the benefits of working with Equifax is we can really drill deep into what information matters most to you and to your business. So for example, if I was meeting with an auto captive company, I would look at this and I would drill deeper and see that their average delinquency rates for auto captive specifically sit much lower. So about 1.7% for a 30+ day delinquency on average, and about 1% for 60-day and just under 1%, so 0.8% for the 90-day plus delinquencies. And again, this in itself, even for an auto captive, will represent a mix of different loans as well. So you can think of the loans and the vehicles that are lent out to businesses for a means of income. So a delivery service, a transportation service, a local contractor, but then there's also a mix of other businesses. So professionals, doctors, lawyers, accountants, and they finance vehicles using their corporation's creditworthiness. So all of those loans are mixed up in here. And when we look specifically on what we call this commercial auto lending side, what we've seen is that there's actually an appetite for expansion because the consumer auto lending is very competitive. And so we've seen a lot of commercial action right now. So we're working with various analytics teams and creating credit strategies that leverage a lot of really predictable data. And again, it really depends on the industry that you're in and on the deals that you service. So again, a lot of auto captives report data into this original, the OG type of Equifax risk database. But again, with the knowledge that there is other databases out there that have that Equifax owns that have a lot of information that they could be leveraging as well. So essentially what we ensure as consultants is that our customers are looking at all the right and most applicable sources of data and helping them make sense of that data in a credit strategy. So for an example, if we were analyzing a certain borrower. This borrower coming to an auto lender looking for a vehicle could have, office equipment or leasehold improvements, machinery, equipment, all these types of asset-based lending history trade lines within our asset-based database. So without accessing that, the lender wouldn't have a full picture of creditworthiness. On the flip side, we've also found that those businesses that are operated, smaller businesses that are operated by an individual and might, be more tied to the business owner's personal credit worthiness, it's really important that we ensure that lenders are looking at consumer credit trends as well. And not in the generic sense of, the consumer's credit score, because again, businesses and small businesses behave a little bit differently. A small business owner does not interact with their credit the same way that a typical consumer would, someone who gets paid on a weekly or biweekly basis. A generic consumer credit score doesn't really capture the true essence of the creditworthiness of someone who, might get large cash influxes. They might have, higher balances trending, smaller repayments, not paying off their entire balances, which might ding them in a kind of generic consumer score. But when it comes to looking at them through the lens of this is a business owner, they behave differently. We can really peel back the layers to showcase the true creditworthiness, especially as we couple that information with commercial credit. So again, consultants hand in hand with our great data scientists here at Equifax, we're helping to bring these insights to you, working hopefully directly with you. So if you are a lender that's looking to essentially look at your credit strategy, we encourage you to reach out, have these conversations so that we can help you really piece together all the numerous pieces of data from our various databases so that we can help you identify which is most meaningful for you. So I might have gone on a little bit of a tangent there, and I apologize. Getting back to this, essentially what I'm trying to say is within this slide, we do see commercial auto mixed in here. We are seeing a renewed appetite for commercial loans because of the fact that their delinquency is so low at this time, around the 1% mark. So it is enabling lenders to really approve more. Kevin, what can you add about the industrial trades from the perspective of suppliers?
Well, Anna, I too have a lot to unpack here as we see several factors at play related to the decrease in trade delinquency. So first off, it's interesting to see that the delinquency rate is dipping, but at the same time, year-over-year bankruptcies and insolvencies, they're also lower by around 28%. Now keep in mind, we're comparing this year-over-year dip or drop in bankruptcy and insolvencies, comparing it to Q3 of last year, which had the greatest amount of bankruptcies and insolvencies in 2024. So take it with some prudence. So the good news is we're seeing lots of transactional activity, lots of businesses happening, and that's really good news. If there's a good news story to take away from this. This good news also is further supported by the recent announcement that Canada added 54,000 jobs in November. This came out yesterday, and unemployment dropped from 6.9% to 6.5%. Again, great from an activity point of view. So while the overall numbers show a slight decrease in delinquencies, it's coming at the expense of a lot of hard work and creativity by many of you on the phone, so good work. And the tariffs, they're undoubtedly impacting many U.S. exporters, but also many downstream businesses. Despite this, we're seeing a lot of resilience where customers are working very closely with their customers and have a lot more greater intimate relationships with them, and successfully, I might add. Some of the common strategies our clients are sharing with us that have been impactful are the following. I'll cover off a few. We're seeing more payment plans for clients that are struggling to get paid by their clients. This is a condition whereby clients are experiencing the downstream effect, where their customers are struggling to get paid by their customers. In some cases, clients that are working closely with their clients, they're looking at the credit reports of their customers' customers as a novel but impactful risk assessment method. Extending terms cautiously and redating receivables when doing so. This one, it's going to be interesting to see how this plays out over the upcoming quarters in terms of the long-term impact. Requesting partial payments up front for new clients when purchasing hard goods. So the customer actually they manufacture hard goods, they buy raw materials to manufacture their products. They have hard costs that will be impactful if their customers don't pay them. They have to cover those costs, unlike services. Requesting more personal guarantees and letters of direction. Letters of directions, we see a lot of that in the construction industry, and we see a big uptick in that. Because we find in construction, which is a massive industry, a lot of the jobs that are being tendered, we're finding that the margins are very thin, so there's not a lot of room for error. So a lot of strategies have to be employed in construction. We're seeing a really big uptick in credit card payments, especially in the small, mid-sized businesses. And it's important to note that companies are using payment processors that use validation codes to protect against card not present transactions. Now, that's another probably key takeaway. We suspect this uptick in credit card use is having some impact on the increase of the credit card debt that we saw earlier in the presentation. What's also important to note is that a lot of small to mid-sized businesses are using not only credit cards, but lines of credit, home equity lines of credit to assist in financing their businesses. And because of factors like this and the increase in personal guarantees, we're seeing increases in the use of our consumer reports and some other supplementary services. The companies that I speak to that are having the most success in managing through the current conditions, they all share various degrees of these traits. And to me, I think these are very key and applicable. So they're focusing on speed, agility, transparency, and execution. Strict adherence to clearly defined SOPs, standard operating procedures, is I can't stress how important this is. This includes more education for frontline workers and new employees to ensure everyone is clear on the roles and responsibilities and demonstrating cohesive behaviors. So for example, strict adherence to credit limits. In the past, we would see at a branch level, companies that would have branches, if a customer exceeded their high credit, they would simply continue to ship. And today, that's just unacceptable. We're also seeing that speed wins when identifying a failing customer. So our clients, they're trying to work with their customers, but there comes an inflection point when they need to quit a customer. No one wants to, but there comes a point when it's time to part ways. And knowing when depends on having the right tools to identify when a customer may be going bad. Now, they may be good with you, but not paying other suppliers. And not knowing this is where surprises lurk. Tighter controls and limits on transactional clients and a move to form closer relationships with key clients is I see that as a recurring strategy in conversation. And tighter relationships with vendors as a partner, not just as a supplier. We're finding more customers are building these intimate relationships. They're exploring things like rebates, customized pricing for key clients. And on the topic of vendors, we're seeing that vendors are being put through the credit lens more frequently, because clients are recognizing that a failing vendor can have a tremendous negative impact on their business if they fail. And so there's a lot more scrutiny on the vendors that they use as, again, a strategy to make sure that they're efficient in all aspects of their business. Back to you, Sinead.
Thank you, Kevin, and thank you, Anna. Next, we will examine the financial trades, which are those loans, lines of credit, cards, etc., from financial institutions that Anna explained earlier. So I'll walk you through this slide. On the left is the trend of delinquency rates for 30, 60, and 90 days. And then on the right, we focus on the later stage delinquencies, so the 60 plus. That includes the 90s. And what we see overall is a nice leveling off of the delinquency rate within our financial trades, which is an improvement from a concerning growth trend that we had been watching. So the 30-day delinquency rate dropped slightly this quarter and sits at 3.79%. And there was a slight uptick for the 60 plus rate, which is at 3.53%. But the 90 plus rate dropped slightly as well to sit at 3.3. Looking regionally, we see that later stage delinquencies are up nationally, but most pronounced in Ontario, Alberta, and Quebec saw improvements this quarter. We'll dive into what's driving that in a little bit, but first, let's look at those delinquencies by product. Okay, and here, we see that delinquencies are increasing on all three primary products over the last 3 years, but most pronounced on lines of credit seen in the middle of the graph on the left. And then breaking things down by age of business on the right-hand side, newer businesses and those truly well-established ones are seeing better results, with the majority of the later stage delinquency rates growing from that middle segment there. So I'll invite my colleague Josh in now at this point to give us some insights on what's driving these trends. Josh works very closely with our financial institution members and has a wealth of insights that he can share about all of this. Hi, Josh. Can you tell us about what we're seeing here from all the discussions that you've had this quarter with the banks?
You bet, Sinead, and thanks for having me. So it's evident there's a lot of stressors in the economy right now, and they're still impacting these financial trades. I think there's a consensus among major lenders that delinquency rates are rising. Is it at the alarm bell stage? No. Is there concern and focus? I would say yes. And it's evident also that there is a need in market to provide funds, especially to those mid-tenured businesses. If we look at the graph on the right here, it's the new businesses and the more tenured businesses probably don't have the same capital demands. There's an investment cycle that's sort of playing out here, where those sort of middle businesses are often the ones that need that funding, that are going to be more heavily impacted even now with all of the challenges around trade, and also suppliers, making sure their supply chains can stay intact despite any changes to tariffs. That said, there's three things that's really causing me to be optimistic and to see a little bit of a light at the end of the tunnel. The first one really is those government programs. I think the government learned a lot about how they can positively affect the economy from the pandemic. And they're doing the right things. They're making the right moves. Providing capital for these businesses that really need to readjust their, or as Kevin said, retool for the new economy. And the second one is technology. Really, there's a big focus amongst all of the major banks, maybe excluding one, on changing up their lending practices for businesses, focusing on new data sets, leveraging AI, really updating a lot of strategies and processes that have been in place for quite a long time generally. And there's been a renewed focus on small business and medium enterprise in ways that I haven't seen in my 13 years with Equifax. So that's, I think, a really positive step. I suspect that within the next 12 months, we will see it getting a lot easier for small businesses to gain access to these funds, to get approved for loans from traditional lenders. And then the last thing that's really causing me a lot of optimism is some of the work that we're doing on our side with our data sets, making sure that our data is clean and organized and is available for traditional lenders to leverage to have confidence in order to make these financial decisions. We're also fully cloud now, so we've got a lot of AI tools that are going to help us with standardization and filling in key data points. So between those three factors, I'm feeling pretty optimistic coming into this year. I don't think the general optimism that we've seen from business owners in Jeff's presentation of the BDC index are unfounded. I think that there are some good things that are going to be happening. And yeah, I think that's it for me. Pass it back to you, Sinead.
Awesome. Thank you so much, Josh. Again, I love getting the insights. It's almost like having insiders, information. So it's very much appreciated. Thank you. So next we'll examine the trends by sector, and here you can see exactly what we've been hearing all throughout today's presentation. So the data on the left are the industries that are reporting higher than the national average delinquency rates, and then on the right, it's the ones that are reporting lower than the average. So on the left, accommodation and food service, along with transportation and warehousing, once again, they continue to show the most repayment strain. And then right below those two lines is retail trade. On the right-hand side, we see drops in delinquency rates with finance and insurance. Those are up there at the top in the brown line. And then agriculture and fishing and hunting are in the red line. Utilities, which is the yellow one, it's a little bit hard to see, but that spiked a little bit, hitting 3.1 this quarter, which is up from the 2.6 rate that we saw last quarter. Okay, lastly, we will look at the asset-based lending data. And for this, I'll call back in my asset-based lending subject matter expert, Anna, to walk us through this slide. Anna?
Oh, thanks so much, Sinead. So we're really coming full circle here, back to the asset-based lending database that we started at together, where we were first looking at inquiries, or what we proxy as the demand for credit. And now we're going to be looking at the delinquencies for the overall industry, as well as by specific industries. So on the left-hand side, we have our small business delinquency index. So there's a solid red line, which represents Canadian data, and a solid gray line, which represents the US data. And both of those solid lines are looking at what we call 30-day plus days delinquency. And Canada, as of September, sitting at 3.1%, with the US sitting at 2.4%. The broken red line and the broken gray line directly below, those are representative of the 90 plus day delinquencies, for which Canada sits at 1.4 and the US at 0.7. So it was right around that time back in 2024, where it was kind of the first time in history we saw the Canadian index exceed that of the US, and it has persisted, although we are seeing it dip a little bit, which is great news. Turning to the right side view, so the per industry view, and really honing in on the last 6 years, you can see just how much of a roller coaster small businesses and everyone who lends to them has been on. So historically, starting on the later years, we were following a pattern, kind of all tight, close to 1% or less. And then in 2023, everything kind of just went haywire. And it was a pain that was felt as the government aid was starting to dry up a little bit post-COVID. So, we do see some relief. So the top line there is the transportation industry. We do see it coming down from those all-time highs. But as we saw earlier in the trends, that there is still a decrease in dollars that's being lent out to the transportation industry. Similarly, the second highest line here is retail. And it maintains a high delinquency rate, which can explain, again, retail having the second largest decrease in new originations as well. But where I felt some explanation might be beneficial was on the agriculture side, given that what we're looking at here is a pretty sharp rise in the delinquency, and yet we saw earlier that there's still lending. There's one of the only industries that has an increase in lending dollars, which at first kind of seems a little bit counterintuitive. So I thought we should dig into it a little bit. And what we're seeing and what we're hearing from our lending partners is that farmers are not really borrowing for growth, but more to stay afloat. So farmers are sometimes forced to take out short-term operating loans, really simply to cover their day-to-day expenses, because we see the price of farming inputs like fertilizer, fuel, chemicals, all of these are remaining persistently high. And at the same crops like corn and soybeans, the prices for those have softened a little bit, and those two things together can really what we're seeing in the rise of this lending index that we looked at earlier. It's not so much a healthy growth in financing, but more so debt accumulation by farmers. So in addition to all of these factors, there's also extreme weather like droughts, floods, late freezes, and these introduce enormous uncertainty that directly affects expected yield, expected revenue for a farmer. A poor season in weather could almost immediately render an operation unable to service a debt. And so while delinquency is increasing, why are we seeing lenders continue to lend into agriculture? And what we're seeing is they're lending on land, and they're lending a lot on expensive, heavy-duty, specialized machinery. And the fact is that these loans are often very well secured. So even if a farmer defaults, a lender can often recover a significant portion of the value of the loan and by selling the collateral. So what we're seeing is, there's also a lot of relationship lending in agriculture. So lenders are a little bit more willing to extend credit to a struggling, but historically very stable client. And because agriculture is an essential sector, there's often the expectation that a government program will step in, provide support, and all of this makes lenders a lot more willing to take on short-term risk. And we're actually seeing this come to life. So in the most recent federal budget announcement, which, it was great. It included a lot of safety nets. There was agri-stability, immediate cash flow relief. There's advanced payment programs. There's a lot of efforts to help grow the top sideline through trade diversification corridors. So the government, like Josh said, is doing a lot of great things to help support the industries that are in need. So even though we are seeing that spike in delinquency, there are a lot of the other industries are seeing some relief. But hopefully that explains why there's a little bit of counterintuitiveness on that agriculture side. That's it for me today. Sinead, I'm going to pass it back to you to speak to the remaining trends.
Awesome. Thank you so much, Anna. Yes, it certainly has been one heck of a roller coaster ride the last couple of years. So thank you very much for those insights. Finally, we have the insolvency numbers for this period. And this quarter reported, once again, a drop in insolvency numbers, sort of getting back to a bit of normalization. kind of like back to where we were pre-pandemic. The only region reporting an increase in insolvencies in the third quarter was Alberta. Okay, so this quarter, it continued the story of businesses prioritizing supplier repayments, keeping business relationships strong when times are tough. It's showing up in the data. We saw those elevated delinquency rates on financial trades persisting this period, which was largely driven by Ontario. That comes as no surprise given Ontario's exposure to manufacturing and financial services, which heightened that province's vulnerability this quarter. In terms of specific industries, financial and insurance industry reported one of the steepest increases in 60-plus day delinquency rates compared to the same period the previous year. But we also saw a concerning rise in delinquencies within utilities. And continuing the trend we saw last quarter, where housing and transportation, along with food service and accommodation, continued its increase of delinquencies. The Canadian Small Business Health Index numbers for manufacturing indicated that the sector is challenged by intense cost pressures, and it'll be interesting to see how those numbers play out next quarter. And so what can lenders be thinking about as we finish up the year? Definitely monitor cash flow prioritization, as that could be both a potential distress signal, but also a tactical maneuver by borrowers. And that's going to help you form your oversight and early intervention strategies. And then alternatively, you might consider switching from broad-based monitoring to more like surgical stress testing of specific geographic and industry pockets. Knowing where to look will help avoid surprises. Okay. So with that, I think we're going to wrap up. Oh, we've got 3 minutes left. Okay, so no Q&A today. We will follow up with anything specific. I'll give you a couple of minutes back to grab coffees. I'd like to thank Kevin, Jeff, Anna, Josh for joining me and sharing their deep